How do these valuation methods typically impact the various financial statements, and from there how does they impact the financial ratios? Because this is one of the important aspects which should be important for any financial analyst before he puts his numbers and calculations into the financial statement. So from that dimension, let's look at the perspective of inventories. What all an analyst should be considering while valuing inventories or while looking at the financial statement from the perspective of inventories. Now, as we all know, inventories have different valuation mechanisms, right? The cash flows with respect to inventories, which is primarily an allocation between the inventory in the balance sheet and cost of goods sold in the P&L statement. So these are the two things that are impacted with the various valuation methods. We know that we have a first in first out kind of a method, a last in first out kind of a method, a weighted average method, and also a specific identification method. So with each of these inventory valuation methods, how do the financial statements really get impacted, and how to build that, how to convert one financial model from the other? All those things we would typically look at right now. All right. Now, whatever is the mechanism that the company is following, there should be a consistency in the mechanism. Consistency is very much required, and that will help the analyst to do the comparison or the performance of the company across time and also with the peer companies. And once the method is changing, it will impact the ratios and hence probably the investment decisions also. So just to look at each of those valuation methods, when I am talking about FIFO, the first in first out. So the goods that are purchased earlier, they go into cost of goods sold, and the goods that are purchased later, means very recently purchased goods, they go into the inventory. So that is how the first in first out mechanism works. The recently purchased ones go into the inventory, whereas the old purchased goods go into the cost of goods sold. So the ending inventory, it reflects the latest and the current cost situation. So in case of inflation, especially the prices are going to go up because the earlier prices go into cost of goods sold. Cost of goods sold may be lesser, whereas the inventory, which actually accommodates the later purchased goods, and because of inflation the later purchased goods are costing very high, the inventory will have a very big number. So when we are talking about the FIFO based valuation method, the cost of goods sold will be lesser. Cost of goods sold lesser could mean the profit before tax is higher. You need to be comfortable with this kind of understanding. The moment the cost of goods sold goes lesser, the profit before tax goes higher, means tax also can go higher, and finally the profit after tax, which is the net income, also may go higher. Whereas when we look at the inventory part, the inventory will be very high because inventory is composed of the later part goods. So the inventory will be very high, which means the current assets will be higher, which means the total assets could be higher, and whatever the calculations that are based on total assets, they are impacted accordingly. Now, if at all the LIPO method is used, when I am talking about LIPO, last in first out, the last purchased goods, they go as a part of cost of goods sold. So cost of goods sold reflects the recent prices, and it is a good reflection of the current prices of the good. So in case of an inflationary environment, obviously this is going to be much higher. So if the cost of goods sold is higher, the PBT is lower, the taxes are lower, so the net income is also lower. Finally, this is the motivation factor for the companies to typically go for LIFO based reporting method, the tax benefit which can come up, because especially during the inflationary periods, I can easily assume that the cost of goods sold is going to go up, and when the cost of goods sold goes up, the taxes will come down because the PBT, profit before tax, will typically come down. So we can say that the ending inventory, which consists of older purchased items, so ending inventory will be a lesser value, so the current assets will be lesser and total assets will be lesser in case of LIFO based reporting method, whereas the cost of goods sold will be higher, which in turn means the taxes, the profit before taxes will be lesser, and thus the taxes also will be lesser. So the net income also falls drastically in case of LIFO method. And because the taxes are lesser, the cash flows are higher. The real tax which you are paying is going down. If there was no taxes, it would have hardly impacted the cash flow statement. The inventory valuation mechanism would have hardly influenced the cash flow mechanism. One thing, no taxes means no impact on cash flow, because it would have increased whatever is not a portion of cost of goods sold, it would have gone into inventory, and change in inventory also would have impacted the cash flows in the same way as the expenses. So probably, so because of that reason, what you find is, if at all there were no taxes, there is no impact on the cash flow statement. Only the P&L and the balance sheet will be impacted because of the change in the inventory valuation method. But because of the taxes, as the taxes are lesser in LIFO, the cash flows are higher, and vice versa. And when you look at the weighted average method, it is more or less even the cost of goods sold as well as the inventory, both of them will be in between the LIFO and the FIFO methods during an inflationary kind of an environment. So this is nothing but on a weighted average basis we will be doing the costing part. And if at all we are talking about specific items going into specific materials, so each raw material can be identified specifically with the element that is getting produced and sold, then we will be using a specific identification method to value the inventory. But whatever is the method, the typical formula associated with the calculation of the ending inventory is the beginning inventory or inventory at the beginning of the period plus purchases that are done during the period minus the cost of goods sold for that particular period. This is what is going to give you the ending inventory for that period. Once we take up a few numericals in this area, it becomes more and more comfortable for you to understand this process. Alright, moving further, just a quick numerical to work out. Given the beginning inventory is 194 units at $5 per unit. So what is the beginning inventory with the company? The beginning inventory with the company is $970 worth. 194 units at $5 per unit was the purchase price. So purchases during the year, $7 per unit, 146 units at $7 per unit, $882. Alright, compute the profit to the company if it has sold. So revenue or sales, 242 units at $8 per unit. So the revenue does not change. So $1936 is the revenue. Now what would be the cost of goods sold when I go with FIFO? When I go with the FIFO, what is the cost of goods sold here? 194 units, I take them at $5, and the remaining 52 units or probably 48 units. 242 units are sold, 194 from the original and 48 from the new, which I have purchased at $7. So this is going to work out to 970 plus 296. So working out to 1266 as the cost of goods sold in case of FIFO, which is resulting in, assuming all other costs are zero, which is resulting in a net profit or net income of $670 in case of FIFO. And what would have been the inventory in this case? Out of 146, 48 are consumed. So 98 goods at the rate of 7, $686 will go as a part of the inventory. So the total thing 1266 go into the cost of goods sold and 686 go into the inventory. Let's say if I am going with the LIPO mechanism, what would be the cost of goods sold now? The latest ones go into cost of goods sold. So the latest 146 items at 7 go into cost of goods sold, and because 242 items are sold, remaining 96 items will be taken from the old inventory, thus taking the cost